Welcome back to part 2 of our swing trading masterclass. In part 1, we laid the foundation, covering the real pros and cons of swing trading to help you decide if it's the right fit for you. Now that you understand what swing trading is, it's time to talk about who succeeds at it. Profitable trading isn't just about charts, it's about mastering your own psychology. Today, we're diving into the mindset of a successful swing trader and building the single most important tool to enforce that mindset. A rock-solid, non-negotiable trading plan. Successful swing traders tend to share a few key psychological traits. As I go through these, ask yourself honestly if they describe you. First, are you a planner? Do you enjoy the process of research, building a thesis, spotting a setup, and preparing a trade before the market even opens? For a pro, the preparation is just as important as the execution. Second, are you a patient observer? Can you sit comfortably in cash for days if no high-quality setups appear? A key skill is knowing that being flat, holding no positions, is a profitable position when the market isn't offering clear opportunities. You don't need constant action. And third, are you emotionally detached? Once you're in a trade, can you trust your analysis and sit through minor normal pullbacks without panicking? A successful trader manages the trade based on their plan, not based on an emotional reaction to the last price candle. So, how do you stay patient and detached, especially when your money is on the line? You don't rely on willpower. You rely on a written, concrete trading plan. You never feel your way into a trade. Every move is mapped out in advance. Every single trade plan you create must include these 4 non-negotiable components. For number 1, your entry trigger. This is your specific objective signal to enter. For example, a daily close above the 50-day moving average on volume 2x the 20-day average. It's a rule, not a feeling. Number 2, your stop loss level. At what exact price is your trade idea proven wrong? This is your invalidation point. If the price hits this level, you exit. No exceptions. No hesitation. Number 3, your profit targets. Where will you take profits? This isn't a guess. It should be based on a logical resistance level, a measured move projection, or a predefined risk-reward ratio. And number 4, your position size. Based on your stop-loss distance, how many shares will you buy to ensure you are only risking a small, fixed percentage of your total account, like 1%? There is no guesswork allowed here. It's pure mathematics. This trading plan is your blueprint for consistency. It's the work you do when the market is closed and you are calm and rational. It becomes your shield against fear and greed when the market is open and the pressure is on. Now that we have the mindset and the plan, we are ready for the final piece of the puzzle, the professional system that makes it all work. In the final part of our masterclass, we are diving into the powerful math of risk management and the feedback loop that turns your trading experience into true expertise. You do not want to miss the final chapter. Make sure you subscribe and hit the bell so you're notified when part 3 drops. Now, let me know in the comments, which of the 4 parts of the trading plan do you find the most challenging to stick to?